Hey, let's bring in Chris Robinson joining us this morning from TJM Institutional Services. Chris, good to have you with us. Let's begin with the 10-year inching its way up to 4.5%, the highest levels we've seen all year.
Yeah, very technical as well. I spent a lot of time doing the very simple technicals. If you go back to the October, November, that I call it the Bill Ackman low, right, where we just stopped and turned around. We had a nice 8-point rally in the 10-year. At Christmas time, we hit that 5-month high. Here we go, 6 cuts. 6 cuts have gone to 3 cuts. 3 cuts turned it into what cut? And the market's repricing for the Fed. I mean, at 4.5%, I mean, it's the highest we've been in 5 months. Anybody out there that's trying to buy a house, you're going to have to pay a higher rate for your mortgage. So it's no joke. It's going to impact what's going on in the market. Again, this is in response to Friday's unemployment number, period. It gives the Fed cover. Now, this is a political year. They may try and get one cut in, but I don't know how they're going to do it if we continue to have such a strong economy.
I'd imagine this is a key area that you're watching, right? Because we are now kind of working our way towards halfway back.
It is. Exactly.
5%. Here's the chart. 5% off the highs from last October, down to those lows that Chris just mentioned here, down around 3.7. Bit of a double bottom there. The retest in the end of January, beginning of February, and here's the move up that we're talking about as we get our way back to 4.5%. We're talking levels we haven't seen since.
Yes.
Well, we're going all the way back to the end of November of last year now. So again, basically halfway back. I wanted to stick with this chart for a second because here you can see a similar pattern, right? Yields, how we've been on a weekly candle chart now, again, going back to the beginning of 2022, down around 1.25%, 1.5%, all the way up to 5%. We've been arguing that, well, for one, we've seen the focus, as you mentioned, in a lot of this recent run up on the data, but pushing back on some of those rate cut expectations, right? So you can see the reflection of that sentiment in the marketplace here.
Yeah, I mean, everybody has an opinion. I love it. I mean, and I stood in the pit for a long time, and that's what this business is all about. So I don't care what your opinion is. What are you going to do if you're wrong? What are you going to do if you're bet the wrong way? How is that going to impact you? And the only way you can defend yourself is to be involved somehow, somewhere, form on the yield curve. And the 10-year is the place to be. And it's a report card every day. You can hold your breath till you turn blue. But if you look at the futures market, we've come halfway back. The next risk for the 10-year is down around 108. Why is that? Well, it would be a 60% pullback. And we've got 6 months before now in the election. 6 months, there's 20 business days in a month. You got 120 coin flips between now and the election. I think you're going to have daily moves like this. And if you don't get locked into some opinion, there's going to be a lot of opportunity.
Taking a look here at, that 107 level that you mentioned, as we are, currently trading, what is that, 109 in the 10-year. I've got the 10-year on the right here. I've got the bonds on the left. If we could pull this up here as we inch our way back down below the 50-day moving average, take out recent lows that we saw back in February, right? So something to watch there. Everybody's got an opinion. That never worked for me in terms of trading, right? I like to trade the charts, price activity, because when I trade the opinion, I get married to what I think should happen, what I want, what I feel like, right? That's not really a good practical approach towards trading, I feel like. But talk to me, because the dollar has had a very level-headed approach towards all of this, right? And so I feel like, yes, although we've seen 10-year yield spiking, we've seen some of the other commodities that we talked about earlier in the show on the move higher as well. It seems like investors and traders are pretty comfortable with stocks holding these upper levels still off all-time highs, but without the dollar really spiking to the upside, maybe we can sustain higher levels in terms of the 10-year.
Yeah, it's a matrix. You've got to look at every market that's moving out there. And you're right, the dollar has had kind of an interesting response. It had been moving higher as people thought that the Fed was going to, make more cuts. So we'll see. That 105 level is big. We're kind of in the middle of a range. If you look at the dollar, that's again, and I'm very chart based.
We're looking at it here right now.
Yeah, we're in this range, and again, we started the year, we were at 8-month low, we were down around 100, we got up to 105 and change. So now that may have been our range established for this year. That's what I would say. You got kind of a little double top right there you can sort of see. So I think the dollar is hanging in there. What's impressive is what's going on with gold and Bitcoin. Boy, Bitcoin if you want action, if you want, you know, if you want to roll a dice on a, you know, every day that's got a $10,000 move. I mean, but then they were higher here again this morning. And again, I think that's in response to the repricing, maybe not by the Fed, but certainly by the 10-year note. I think the 10-year note is driving a lot of these. And as the 10-year reprices, you'll see the dollar reprice, you'll see gold and Bitcoin reprice. It's just going to come down to which one is repricing in a more violent manner. Right now, it's gold and the Bitcoin.
Yeah, Bitcoin not far off that all-time high. I just wanted to take a look here because we pulled up a dollar on the daily 1-year candle chart, but take a look, a very similar pattern, right? Halfway back, if you look at where we are comfortable in this level, right around this 104 handle, and halfway in the middle of the range that we established going all the way back to the beginning of May of 2021, up around 122 down to, we'll call it 95, 96 in the fall of 2022, and then here you can see again right in the middle of that range. So Chris, these are key levels to watch. We appreciate you joining us and sharing part of your Monday with us. A lot of focus on 10-year yields to the highest levels we've seen all year and the impact that's having on the indices. Thanks to Chris Robinson from TJM Institutional Services.